Have you ever overheard some people talking about the S&P 500 or the NASDAQ and you just kind of nod your head along? Or maybe you overheard it in the news and you just wondered, what are they talking about? Well, you're in the right place. You'll be able to impress your friends and follow along with the news thanks to this video. My name is Ashton and welcome to Market 101, where we give you the basics on finance, economics, and of course the market. In this video, you'll learn about the top market indices. But first, you're probably wondering, what is a market indice, or rather an index? A market index, like the S&P 500, is a hypothetical portfolio representing a segment of the financial market. Yes, you heard me right, a hypothetical portfolio. You don't actually invest in the S&P 500, which I know is a bit confusing. The index just gives you a picture of how that financial market is doing. But if you wanted to invest in something like the S&P, you would look for an exchange-traded fund, or an ETF. I know, we haven't even covered the top 5 indices and I'm already throwing ETFs at you. Comment down below if you want a Market 101 on ETFs. So now let's get back to the indices. Starting with probably the most recognizable one, and one that I've already mentioned several times, the S&P 500. The S&P 500 is short for the Standard & Poor's 500 Index. It was created in 1954 by a credit rating agency, Standard & Poor's, and it looks at the 500 largest U.S. publicly traded companies. Basically, the S&P looks at these 500 companies' stock prices and pulls them all into one grouping, then puts them on one single chart so you can see if it's going up or down. Another thing about this index is it uses a market cap weighting method. It gives a higher percentage to companies with a larger market cap. If you're not sure what a market capitalization is, we actually made a few short videos on our shorts channel, The Market Minute. Links are in the description if you want to check it out. The market cap is calculated by taking the company's current stock price and multiplying it by their outstanding shares, which are all the shares held by investors. So then the company weighting in the S&P is equal to that company's market cap divided by the total of all market caps in the index. If you look at the history of the S&P 500, you'll notice an upward trend. There have been a lot of recessions between now and 1954, but the graph continually goes up. The American economy is rather resilient, and that means the single best strategy for investing is to stay the course, be patient, but be prepared for a bumpy road. Obviously, we can't guarantee that the economy will go up forever and ever, but there is a level of comfort in looking at the S&P 500 and seeing this upward trend. Now let's talk about another popular index, the NASDAQ. NASDAQ stands for National Association Securities Dealers Automated Quotations. Wow, that's a mouthful, and honestly doesn't explain what the NASDAQ is. Well, it was launched in 1971 as a way to make stock trading faster in a world of computerized systems. A lot of tech companies are actually listed on the NASDAQ, and in fact, if a startup is listed, it can generate a lot of capital for them as opposed to if they were listed on the New York Stock Exchange. Now, there are actually two components to the NASDAQ. One is a trading platform and the other is the index. The trading platform is where you make the trades, and the index is called the NASDAQ Composite, and it represents the overall performance of how the platform is doing. The majority of stocks listed on the NASDAQ are from the technology industry, like Facebook, Amazon, and Apple. So if you're looking at how technology is moving in the market, you can go to the NASDAQ. Or if you wanted to trade, you can also go to the NASDAQ. The S&P looks at the top 500 companies, and the NASDAQ currently looks at 3,584 domestic and international companies. But something with a more narrow lens is the Dow Jones Industrial Average. Named after Charles Dow and Edward Jones, the Dow Jones Industrial Average, also known as the Dow 30, looks at 30 large publicly owned companies that are traded on the New York Stock Exchange. It was created in 1896 to illustrate the broad U.S. economy, and obviously, it is still used today. The companies listed on the index have changed over time as the economy has shifted and businesses have come and gone over the years. All of the 30 companies on this list are described as blue chip companies, and all that means is that the company is reliable and consistent with earnings. Right now, the top companies on the Dow Jones include Apple, Amazon, American Express, Boeing, Cisco, Home Depot, and many more. So far, the indexes we've covered have looked at the largest or the top companies in the United States. But what about the smaller companies? The Russell 2000 is a market cap weighted index similar to the S&P 500, but it focuses its attention to 2,000 U.S. small cap companies, which makes it a great tool for investors looking to invest in small caps. It was launched in 1984 by the Frank Russell Company and is looked at as an indicator for the health of America's economy, which was especially relevant during the pandemic when smaller companies were hit harder than larger companies. It's also exciting to watch smaller companies because they have the most potential for exponential growth, unlike companies who have already been around for decades and are sitting at the top. So what if we wanted to know something else about the US economy? Like, how are people feeling about it? Well, let's look at the VIX. The VIX is a volatility index created by the Chicago Board Options Exchange. It is often referred to as the fear index or the fear gauge. It measures the 30-day expected volatility of the US stock market. To understand how they measure this, you'll need to know what options are. But for now, think of it like insurance. The VIX tracks how much people are willing to pay for insurance on the S&P. If the price of options goes up, meaning people are willing to pay more for insurance, then the perceived level of risk in the market has increased. And vice versa. If the price of these options goes down, so will the VIX, because the perceived level of risk in the market has gone down. And there you have it, the top 5 market indices, which illustrate different aspects of how the financial market is doing, from large cap companies to small cap businesses to even how fearful investors are. Knowledge is power, and knowing more about your finances is huge, which is why you should subscribe and keep empowering yourself with information. Go watch this video for information on how reaching your first 100,000 takes as much time as reaching your first million.